Hello and good afternoon, everyone. Thank you for joining the call. On the call today, I have with me from Zensar management team, Ajay Bhandari, Head of our Strategy and Corporate Development, Vivek Ranjan, Global Head of HR, Sanjay Rava, our Global Financial Controller. We also have the call joined by Navneet Khandelwal, who has recently, a couple of days ago, joined us as our new CFO. I will give you a brief overview on how the last quarter Q3FY18 went for Zensar. This will then be followed by an update on other financial matrices by Navneet. Post that, we will open the floor for questions. I trust all of you have had a chance to go through the detailed Q3FY18 financial results and the fact sheet that we released yesterday on January 18. Let me take the opportunity to present some key details from our results and business performance in Q3. Q3 was another good quarter for us. On an overall basis, we had a revenue growth of 3.4% sequentially and 5.1% year-on-year, both in dollar terms. Our gross margin and EBITDA grew smartly Q-on-Q and went up by 8.2% and 17.9% respectively, again in dollar terms. Our net profit, however, saw a sequential decline due to exchange impact and higher taxes. We are also happy to report that Keystone, the company we acquired in March 2017, continues to perform well. Keystone had a great quarter and grew over 12% sequentially. The synergistic capabilities of Zensar and Keystone is generating a lot of interest and traction within our client base, particularly in the retail sector. We see more business being booked by our combined delivery capabilities and solution offering. Foolproof revenue saw a decline this quarter due to furloughs. However, we are quite excited about the growth in the pipeline and the wins that we expect, particularly in the CX/UX, the digital agency and the CMO/CDO space in the European market segment. Our digital revenue accounted for just under 39%, 38.8% of the overall revenue, and grew quite well, 9% sequentially and 35% year-on-year. Both our core application services and the infrastructure services grew this quarter. Application services grew 3.5% on constant currency sequentially, which is predominantly driven by the digital revenue growth. Overall, IM business also grew 3.5% sequentially, despite a decline in the maintenance business. The IM business growth was driven by strong growth in IM services component, which grew 7.5% sequentially on constant currency. The maintenance business, however, degrew sequentially, and we are working towards ensuring that profitability level of that business are optimized to the maximum possible extent. As we have mentioned in our earlier calls as well, that's a continued area of focus, for the management team. Our key market of US delivered a solid growth of 5.3% on constant currency sequentially. Africa continued its great performance and grew 3.3% sequentially on constant currency. Europe, predominantly on account of foolproof revenue, actually saw a marginal decline due to the furloughs and seasonality of the business. In terms of the vertical market, all markets grew. Financial services grew 6%, manufacturing grew 5%, and retail about 1.8% on constant currency. Towards the end of last fiscal, we had talked about our focused three-in-a-box strategy for our top clients to leverage the available growth in the headroom. We continue to focus exclusively on our top client, and as a result of that, you've seen continuous movement in our top 5, 10, and 20 clients. They all grew 6.1%, 6.3%, and 3.2% respectively. Our focus on digital continues to be very, very strong, and it's the key part of the business strategy as well for us. Return on Digital, which is Zensar's proprietary solution framework, which we had launched at the end of first quarter in fiscal 18, continues to gain very good acceptance from our clients, and is now at the center of almost every deal that we are fighting in the marketplace. We have closed $1 million of revenue on the Return on Digital platform itself, which indirectly influenced close to $8 million on the traditional services business also. Our other digital solutions like Zen Analytica, Vinci, and Digital Workplace continues to have great performance and great reviews, not just from the client, but has also gained significant acceptance in the analyst community, as well. Zen Analytica is driving the growth of analytics in our business, and several digital as well as traditional deals now have Zen Analytica as a critical component into the analytics sector, which also leads us quite well into the upcoming artificial intelligence and the machine learning category. Most of our wins this quarter have been in the digital space. Overall, the wins from the company last quarter was 100 million TCV. You will find the details on some of the wins in the press release, but I'll call out a few for quick reference here. We won multiple deals across experience design, digital commerce, analytics, and automation. We won experience design services deal for one of the global leaders in beverages, a leading insurance company in the UK, an integrated business and IT systems company in the United States. We closed several digital commerce deals as well for retail customers, microservices for a very large American home furnishing company, also a US company with vast range of business services, particularly to financial services and SMEs. We also won a multi-year deal from an American clothing and accessory retailers, order management and digital supply chain from an American chain of luxury departmental store. Analytics deal with one of the largest paper and packaging manufacturer in South Africa, a robotics process automation deal from one of the largest American companies in risk mitigation. We've been very pleased with the traction that our digital offerings are making in the marketplace, which is also helping us position well in the traditional services offering as well. We've also had win in core services across the traditional category, multi-million-dollar application re-engineering deal from a large American high-tech company, multi-year managed services deal from a large European bank, a testing opportunity and testing deal from UK multinational electricity and gas utility company, a maintenance and MVS deal from an American multinational biotechnology company. Our utilization from an operating parameter perspective dropped 110 basis points sequentially as we've ramped up staff for the new projects. Net addition was about 200 people between Q3 and over Q2. We continue to get included across various industry analyst reports by reputed analyst firms. Zensar was mentioned in Everest Group Cloud Enablement Service, Market Trend Peak Matrix Assessment. We were also captured and featured in Gartner Market Guide for Enterprise Architecture Consulting. Zensar was mentioned in Gartner Competitive Landscape, partnering with third-party maintenance, particularly for data center and network management. We were named Rising Star in the ISG Provider Lens Managed Digital Workplace Quadrant Report 2017 and a leader in ISG Digital Workplace Report in 2017. We were called out as challenger in the application support and maintenance category in the ISG Application Development and Maintenance Services Report. Overall, I think we are very pleased with the operating numbers that we have delivered in Q3 and the progress that the company is making, particularly towards the digital-led transformation deal for our customers in the retail, financial services, and the manufacturing category. With that, let me call Navneet, our CFO, who just joined us to provide us a quick update on some of the additional finance data. And after that, we will open the floor for questions. Navneet?
Yeah. Thank you, Sandeep. Good evening, everyone. Welcome to this call. In addition to Sandeep talking about the business, I will take you through some of the financials and the P&L as well. We have reported revenue for the quarter at rupees 7937 million, which reflects a sequential growth of 4.1% in rupee terms, while in US dollar terms, the reported revenue is $122.6 million, reflecting a growth of 3.4% sequentially and 5.1% year-on-year. The US dollar realization during quarter has been 64.72 per dollar as against 64.30 in the quarter before, and year before in the same quarter it has been 67.40. The gross margin for the quarter improved by 134 basis points over the previous quarter despite of lesser working days in the US. We had been able to achieve this through business efficiencies driven by return on digital platform internally deployed in Zensar and growth in digital business. The effective tax rate for the quarter is at 33% as against 26.2% in the previous quarter. This is primarily due to the increase in profits in our US business, and quarter 2 included a one-time gain in India taxes which is not recurring. Consequently, the PAT reduced by 6.3% over the previous quarter. DSO stood at 66 days as against 65 days in Q2. The total amount of outstanding hedges as on 31st December 2017 was equivalent to $47 million against $70 million in the previous quarter. With that, I come to the end of my presentation and open the house for questions and answers.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants who wish to ask questions may press star and 1 on their touchtone telephone. We have the first question from the line of Mukul Garg from Haitong Securities. Please go ahead.
Thanks for giving me the opportunity, and congratulations to the management. Quite a good quarter. The first question was on the business growth in the quarter. Can you give us some sense of, given that AMS and manufacturing both did well in a seasonally weak quarter, what is the sense of the demand environment currently in the market?
Ajay, you want to just bring it color and then
Yeah. Hi, Mukul.
Hi.
So the demand environment so far, Mukul, I think it's good. We are not seeing the large deals as yet, but we are definitely seeing a lot of small deals happening. So in a way, a lot of the deals are kind of led by digital, and even where there are, let's say, quote unquote legacy or traditional deals happening, that is also done with the end objective of doing something in digital. So the demand environment is positive. There is business out there. You're just not seeing too many large deals, but multiple small ones, and I think that probably is also a commentary on the state of the industry, where the very large deals are kind of slowing down, especially in our marketplace.
Understood. And Ajay, similar to this, there were quite a few $1 million deals in the press release. So, have you started seeing faster decision cycles and more budgets?
We are definitely seeing it in digital, Mukul. So there are pockets, especially if you look at, we did mention that a lot of our deals are led by our digital platform and also around e-commerce. So if you look at our e-commerce business, that started growing again, and a lot of this is related to transformation of e-commerce sites, and in many cases, transformation of any front end kind of application where the whole experience is being redesigned, and there's a big demand coming for UI, UX, front-end development, Java, skills, so especially development with more agile DevOps, etc. So a lot of such deals happening, and these are happening actually in short bursts, short cycles, which is why the deal sizes are smaller.
Got it. And if I can squeeze one final question, Sandeep, I think last 2 quarters both have been quite good. So, I know you guys don't provide guidance, but what is your sense? Are you seeing a return to more usual business growth going forward? What is your initial sense for CY18?
Yeah, thanks, Mukul. Yes, you're right. We don't give any forward-looking guidance, but from where I see, and I think Ajay touched on several of those aspects. We actually see pretty good demand environment. US, which is our core market, 70% of our business is US. The US economy and all the broad, parameters, financial parameters in US is doing quite well. The tax reforms, I do believe, is going to help spawn more investments, particularly in the technology and more digital area. So we are seeing good demand environment, and we continue to be pretty optimistic about the deal pipeline.
Got it. Thanks for answering my question, and all the best for the new year.
Thank you. Thanks, Mukul.
Thank you. Participants who wish to ask questions may press star and 1 on their touchtone telephone. Participants in the call, if you wish to ask questions, you may press star and 1. We have the next question from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Yeah, hi, sir. Congrats on a good quarter. So last year we had weakness in 4Q, and I think even in the earlier year. So how would be 4Q? Would there be any quarterly specific weakness this year also?
No, Manu Babu, I don't think. I think we had a very exceptional fourth quarter of last year, particularly on account of decline, and we had called that out at that time, on the product business as well as some government business in India. I don't see both of them, coming, and we do hope. We are all working in our management team to, continue to win, particularly in the area that we compete in. We compete in digital transformation-led deals, and our pipeline is looking good. So no guidance, but we feel pretty good about fourth quarter.
Yeah. So when we will have a good 4Q exit rate, so next year we would be on a strong footing to deliver around 10 to 12% growth. Is that the way to read it?
Well, I won't read any forward guidance, but right now we are focused on making sure that our propositions are sharper, better, we fight and we win. And that's the entire focus. Also, you've seen some spotty performances earlier in particularly our infrastructure services business. Q3 of the infrastructure services business was good, but previous quarters there have been some spotty performances on the core IM business. So we are very focused to make sure that we put the right team in place, in the United States, and deliver the core volume businesses as well from IM. So application, which is led by digital, IM, which is led by cloud, is the center of our strategy. And at this time, our entire focus is to make sure that we execute well on that plan.
So how is Vinci enabling in terms of new deal wins in the IMS side?
So Vinci is a key part of our IM cloud orchestration proposition itself. It is the center of autonomics led pitch that we do to our clients. And we had mentioned about it in our earlier calls. We are currently running pilots and proof of concepts in over about half a dozen of our customers. All indications and reports are actually quite good. So you should see at least many of them getting converted into full-fledged deals over the next couple of quarters. It's not going to happen in the next, immediate quarter or so, but over the next couple of quarters, you will actually see, improved wins in IM business enabled by Vinci. I mean, Vinci and digital workplace are the two key components of our IM strategy.
And what could be the deal sizes, sir, from this platform-led strategy in IMS? What could be the typical deal size?
Put a number, but I think it will be in the $10 million range TCV.
Okay. And one last thing from my side. So now that we are focusing more on the UX and CX part of the digital transformation, there could be vertical agnostic opportunities, say in the newer verticals like say travel or some other fintech or some financial services, etc. So how are we trying to leverage into new verticals?
Yeah, I think it's a great question. Yes, CX, UX is a horizontal strategy. However, our vertical focus also is quite sharp. I mean, 96-97% of our business actually comes from just three markets, which is retail, financial, and manufacturing. And our first focus is to really grow at scale into those three markets before we horizontally spread ourselves into other markets. So I don't think we are going to go all over the place. There are a few tactical wins you will continue to see, particularly because of client movements. The existing client moves from a customer A in an industry to a customer B in a different industry. And, many a times they just want to continue to work, with us. But other than that, I think our strategic focus continues to remain deep into, and we have stated that time and time again, fewer markets, fewer customers, but go deep, provide multiple services. That's the reason we acquired Foolproof and brought that competency in. And it is a part of our growth strategy as well, that we take CX UX first into the market that we are in.
Okay. And the top client traction has been very well. So do you expect, that kind of momentum, and, how is the digital being sold to your top accounts?
Yes, and we mentioned that earlier as well. I think we have completely redone our strategy for our top client. And the top client is quite significant for us. We've converted many of the T&M into managed services. That's the first step forward which we have taken into that top client. We have also won some non-IT deals which are digital led. So analytics, campaign, data, IoT. So our growth strategy in that particular relationship is now a more balanced strategy rather than just being traditional IT application and IT support strategy. And we have seen some very good traction, and we've got some pretty good wins. That's the reason why you're seeing traction coming into the top 5, 10, and 20 account, which is a part of our pretty strong performance over the last couple of quarters.
Okay, and what would be the effective tax rate for the coming quarters?
Navneet, what's the effective tax rate for the coming quarter?
Yeah, so actually, we'll typically not make a forward-looking statement on that, but this quarter has been unusually high. We expect it to come down in the subsequent quarters.
Okay, sir. Thanks a lot.
Thank you.
Thank you. Before we take the next question, we'd like to remind participants that you may press star and 1 to join the question queue. We have the next question from the line of Vishal Desai from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations to the management on a strong set of numbers. I had a couple of questions. First one starting off with in terms of the deal pipeline that we're seeing. Could we get some sense in terms of what is the deal pipeline currently standing at? And secondly, could we break it down into our key market of US and what kind of work are we envisaging there in terms of the pipeline?
Yeah, Ajay.
So Vishal, our deal pipeline always hovers around 700-800 million, and kind of this quarter is no different. But if you had to break it down into by geography, and then it more or less tracks the same percentages as our geographic concentration. It's around 70% towards US, around 15 to 18% for Europe, and the balance for South Africa. The types of deals have started changing. As I mentioned earlier, earlier we used to have a lot of, say, Oracle large implementation kind of deals. These days we are getting a lot of deals in a variety of new areas, especially the whole digital engineering piece, which is anything to do with development of digital platforms. Also a lot of deals in mobility, cloud, even IoT, anything to do with AI or analytics in general. A lot of these deals are smaller, they are $1 million or 2 in size. And typically there will always be 2 or 3 large deals we are chasing, which are fairly large in size, maybe 50, 100 million. But off late, most of our wins have been in smaller deals, 1 to 5 million kind of ACVs, or at best $8 to $10 million TCVs. But largely digital in nature, which are project based, less annuity at the moment. This is why you may continue to see some fluctuations in utilization. But on the whole, as far as the trajectory of the business is concerned, moving a lot more towards digital rather than legacy.
Sure, that's helpful. Secondly, I just wanted to understand in terms of, is there any kind of color that you can give in terms of your top 20 accounts? While I know the earlier question was hovering around this, around how and what is the traction that we are seeing on the top 20 accounts in terms of our digital offering. And obviously, I assume that we are maintaining our overall 3-year horizon of 50 to 55% of revenue coming in from digital as well.
Yeah, so we have identified our top 20. I mean, like any other organization, we have strategic plans built for each account, and there's a team that, and there's some rigor that goes through for the growth of these accounts. Of late, since most of our clients, especially in the top 20, have either put a freeze on legacy, or or there is some pressure on prices also in some cases in legacy. The bulk of the spend is in the digital areas, digital or cloud areas, and of late we've ramped up our capability significantly both in India and in the US to attack that part of spend. So therefore you'll find probably a uniformity in the strategy for all these top 20 accounts where we are trying to penetrate at least in a large part of the digital stack. We are leading by a few solutions. We are leading by supply chain or omni-channel, largely in the retail, or at least industries affected by omni-channel in our top 20, or by customer experience in the BFSI, retail, insurance, and adjacent areas. And if it's high-tech manufacturing, both areas still apply. Only in the traditional manufacturing areas, we are still chasing IM or Oracle deals. So it's not like Oracle has completely evaporated. We just signed a $24 million deal last quarter for a large tech major to do Oracle implementation as well. So there are all kinds, even though it's leaning towards digital, and we are definitely trying to sell a lot more of our ROD, the Zen ROD platform, which is both a product platform and a capability play. And typically, when we make presentations to clients on sale of this product, the business invariably comes either in the form of buying of the product itself, or sometimes it's about buying the platform, and sometimes just capability. So the business at the moment is definitely tilting towards a lot more digital in top 20.
Sure. And last two from my side, if I may. In the infrastructure space, we had mentioned that the maintenance piece continues to be in a little bit of overhauling for a couple of quarters. How far are we thinking out on this from here on?
So as far as maintenance is concerned, I think we mentioned in the last quarter that we have a new team. There's a completely new team which is looking at. They have been brought in from the tier 1 maintenance players. We now call it TPM, or third party maintenance. So we've looked at TPM players and brought some of the best from the TPM industry to manage this business. It does require a complete change in the way we sell, as well as the change in the way we deliver, and that is currently in process. Maybe still 3 or 4 quarters away before we show a complete turnaround.
So just last thing from my side in terms of the Foolproof acquisition and Keystone, any kind of commentary that you can provide in terms of cross-selling, and EBITDA margins have been at around 13.1% or 13.3% to be precise. Could someone just, give me a sense in terms of what are the levers that we have going into Q4 and the next year?
So, actually, I will address that with Sandeep here, Vishal, but I'll also add a quick comment on the TPM business as well. We have stated it continuously. That is a profit improvement area for us. It's not that much of a revenue play. And we have a couple of quarters to do before we, get a full handle on that business from a significant contribution to our profitability. It's a work in progress. It will take us a couple of quarters. Foolproof business, I think the integration is done. Integration is complete go-to-market. It is a part now of our European business. It's a London-based company that we have acquired. They have a very small Singapore office and a Singapore play in the Southeast Asia here. But I think 95% of the business is actually UK driven. So the go-to-market alignment with our European UK sales team is complete. EBITDA alignment, I still think the EBITDA, given the fact that the service delivery model in the digital agency, CMO, CDO, CX, UX world is largely going to remain on site. I think you will continue to see the EBITDA in the same range, for that business. I don't think there is a significant change expected there.
Sure. And lastly, on the margin levers at the consolidated entity, what do we have in terms of levers that can be picked up from here, given that utilization has anyways been targeted by the management of around 83%?
Vishal, the biggest lever obviously is to move our infrastructure business into a more profitable zone. I think that in itself should provide you an uptick in margins. So if we continue to do all the good stuff we are doing on the application side and turn around the profit profile of our infrastructure business, then I think you will definitely see a margin uptick.
Sure. Thanks. All the best.
Thank you.
Thank you. Before we take the next question, a reminder once again to our participants that you may press star and 1 to join the question queue. The next we have a follow-up question from the line of Mukul Garg from Haitong Securities. Please go ahead.
Thanks for the opportunity again. This is Karan here from Haitong. Sir, a question again on EBITDA margins. So do you think EBITDA margins can reach again to FY16 levels in the next 1 or 2 years?
So, we don't give forward guidance at all. And our focus at this time is to deliver consistent performance. That to us is most important. Number 2 is to really sharpen our proposition on go-to-market. And I think Ajay explained to you about the digital-led strategy. The reason both of these become important is they do have a margin play. So if we get both of them right, I do think you will actually start to see, stabilization and, some improvement across gross margin and the EBITDA track. You do have, some amount of headwinds. I mean, these are projects, right? So these are not typical traditional annuity-based business. The projects come and the project gets delivered, so the whole sales cycle, starts all over again. In my commentary earlier, I actually called out about ROD platform, which we sold. It's like a product, right? So we sold $1 million worth of that last quarter. We sold about $400,000 the previous quarter, and those are significant addition to the margin, and it goes all the way into the EBITDA number. So it's a combination. No guidance, but our endeavor certainly is to deliver a consistent performance across all, operating financial parameters.
Okay. Thank you, sir.
Sure.
Thank you. Before we take the next question, we'd like to remind participants that you may press star and 1 to join the question queue. Next, we have a follow-up question from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
So we have earlier executed some RPA deals in South Africa. So how is the pipeline there? I mean, after we have a good client reference as well now. So would we chase more deals on the RPA side as well?
So Madhu, this is Ajay. Yes, I think RPA pipeline is good. We continue to do, and RPA deals are of all types. So where we play a pure consulting role to where we do a complete managed service. The number of bots that we have in the market is like continuously on the rise. So it's definitely an area where we are seeing traction in certain sectors, in insurance, even pockets of manufacturing. And of late we are moving. The use of RPA is moving slowly away from pure transaction processing, and in some cases even being used to is like an IoT kind of device, which is used to automate certain transactions. So yes, like analytics, RPA has the potential of becoming a fundamental aspect of practically every outcome based offering that we are doing at the moment.
Okay. And second, on the financial services on the developed market side. So we are strong in the insurance, but not much on the banking side. So on developed markets banking, are we trying to chase the opportunity through some acquisition, or we would, as of now, not focus much there?
So I think, Madhu, your assessment is right. Banking for us is actually quite strong in the European, UK, as well as in South Africa. In the US, it's not been that strong. We do have some smaller banking clients. And at this time, using the digital strategy that we have put for insurance, we are actually taking that to a few banking customers. We have seen some pretty encouraging initial set of results from the pilots that we are doing. I don't want to comment on the acquisition strategy on the banking, but our initial focus on banking is to definitely use digital as a lever to get into some of the tier 1 and tier 2 banks in the United States.
And so there appears to be some senior management addition over the last 2-3 months. Any new additions there on the vertical side?
Yes, I mean, we've got new addition. We've got a new head of our infrastructure services business in the United States. We talked about Navneet, who joined. We've got a new head of our retail business in the United States again. Vivek Ranjan, who joined us as the CHRO. We've got a new head of digital sales in the United States. So we've got quite a significant lineup of industry experts and from tier 1 companies joining us, particularly in the last 100 days.
Sir, and just one last question. So on the digital, I mean, obviously the project sizes are smaller and could be a relatively higher on-site component. So would that be a challenge for the margin for these projects, or I mean, how do we go ahead on that?
So yes, the answer is in the initial phase of the program, there will be some impact, but that happens traditionally in any business that you do. When you are doing initial on-site centric work, it comes at an on-site centric margin. And then, of course, the job is to make sure that we do it in a balanced global delivery model, so that you achieve the margin at the company operating margin level. But those spikes, we will have to manage it. So, in some digital pockets, if it's low, in some traditional business that we win, you've got to deliver higher margin so that you balance it out.
Okay, and just on the skill set, so how are we finding that? I mean, at least this is a niche skill set, so how is the labor market over there, and how are the cost pressures from the skill set side on digital?
So I think we are training our people extensively on the digital skills. We've talked about it in our earlier calls as well on what we've done to essentially train 100% of Zensarians around the world on the service delivery, operations, and client engagement team, and that continues. But I'll call on Vivek to add some additional points on what we are doing for training on digital.
Absolutely. This is going to be focus number 1 for us, and we have taken multiple initiatives under the project of talent transformation, where we have built up a robust digital academy, and we have moved quite a few of our employees, and they are undergoing in-depth training in this space through our digital academy. So this will remain a key focus area for us.
Okay, sir. Thanks a lot.
Thank you.
Thank you very much. That was the last question in the queue. I would now like to hand the conference back to the management for any closing comments.
Yeah, hi. Thank you, everyone, for dialing in, and thank you for the questions. We've delivered a pretty good set of numbers in quarter 3, and we see good pipeline and the good deal momentum continuing. So thank you for your support, and we look forward to talking to you again in quarter 4. Thank you. Bye.
Thank you very much. On behalf of Prabhudas Lilladher Private Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.